Hello, traders. It's 8:02 a.m. here in downtown Chicago on the 24th of September 2018. It's a Monday, brand new week, new opportunities. Rollover's done, expiration is done, and here we are, market moving under the power of news, under its own power, and the power of rebalance and change. Thanks for joining me for another Trader Bite. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. This morning, the market is allocating to safety somewhat, although I see that the U.S. Treasury bonds are down 3 ticks. The 10-year notes down 2.5 ticks. The Bund is down, looks like, 20 ticks. Pretty much everything is down except for gold, the pound, and crude oil. Crude oil is getting some news out of Iran. And the background behind this drop, and by the way, if you're trading the euro or Eurozone-based products, just be aware that Draghi's releasing comments on the economy at the Econ Committee meeting in Brussels right now. He started about 3 minutes ago. So the driver behind today's action is the initiation of these tariffs. The two biggest economies in the world, the U.S. and China, are duking it out, and China is coming out and stating that it is not backing down. And that the door of negotiation stays open, but talks will not happen under the threat of more tariffs. So this is just a kind of a fight that continues on, and the market's responding. The market responded last week with new all-time highs at in the S&P at 2946.50 on a December contract. So even though we see that the U.S. tariffs on $200 billion in China goods takes effect, China has canceled these upcoming talks, and it's giving us a small gap down. So this is where we are. This is what supposedly is driving things currently, and that's what we have. I want to remind you that Friday we saw the rebalance, not rebalance, like my Twitter message said. Autocorrect on my phone. A rebalance which caused a bit of a shuffle and a creation of a new sector, communication services. And I'm still digging around looking for what the exact weightings will be for the top 5 sectors in the S&P. Haven't found anything good yet. I could find plenty of information on what the GICS reshuffle is. But I'm not getting a comprehensive. The S&P 5, the Standard & Poor's website still shows August weightings, so I'll dig through that some more. Maybe it's on Bloomberg, probably is, and then I'll post it when I get it. Anyway, so that's what's on deck. Again, ECB is talking. Currently, the Germans got the IFO business climate number this morning. What does the week hold for us, in store for us? Today is pretty clear. The deck is pretty clear. Tomorrow, Tuesday, we get Case-Shiller and consumer confidence and so on. Wednesday, FOMC, big deal, big deal. Fed's Powell to speak. Thursday's got a lot of releases in Europe and in the U.S., and so does Friday. So this week we start out with, it's like a steady climb into FOMC, and then we continue to ascend into the number of releases for the week. There's a lot coming out this week, so we expect some impact on our auction as we go along this week. Let's take a look at what was expected on Friday. By the way, the S&Ps have been very, very chopped up since the open yesterday. Let me show you this real quick. Bookmap. If you're interested in the software, the website ctbookmap.pro. If you look at what it's been doing, we did gap down in the S&P, but it's interesting in that the depth has been quite stable throughout the night. We've had, this up here just sitting here and holding steady. This is into the prior day's low. I'll talk about this a little more later. And then 2920 is seeing some defense throughout since the reopen. It's interesting to see. It looks to me, based on that we'll have a deadlocked session, kind of a session that isn't likely to go anywhere. Here's what I expected on Friday. Friday we were gapping up, and we were gapping up, and the expectation was responsive. I discussed the premise behind that, why the context supported responsive selling, and I was looking for responsive selling into 29.33. Remember, the green is the primary or the most likely scenario given the action so far. What was Friday's low? Friday's low was 29.32.5. Here's what happened Friday. Open auction, just as expected. It played out almost too perfectly, kind of bothersome. Open auction extends the range lower, extends the opening swing lower after testing higher, couldn't move higher, and then gets back to the prior day's close, gets tangled up, tries to get out again, falls back in, and goes down to 29.33.5, expected 29.32.5, expected 29.33, closed near lows. Almost exactly what was anticipated. Here it is. A push into the prior day's close, bounce around a little bit, move into 29.33, and then just stay inside of the range. And at 29.33 is the low volume node. It's also areas that the market reacted, where the market reacted the prior day. They show up on the profile, but also in the price action. I'd rather see them on the profile. So again, Friday played out beautifully. And then on the close on Friday, just a gargantuan rebalance volume there. Huge amounts traded on the close. On the closing 15 minutes, 235,000 contracts. Very, very unusual. And we saw a little bit of volatility coming into that. Friday's low, not the most fantastic low I've ever seen. Looked kind of weak, and then this morning we open up and we are trading below. We are down here this morning at 29.2650. Let's take a look at what has happened in the overnight session as we follow our standard program. There it is. Gap down, 29.2950. Push lower on the news. Consolidate, extend, and then consolidate and consolidate and consolidate. And what we have is a bit of a P-shaped profile, but it's not a P-shaped profile where we started down here, pushed up, and then consolidated. It's a P-shaped profile that extended down and then came back up to the heavy part of the profile. So this, to me, does not signify, this is tricky, doesn't signify short covering to me at all. Short covering is when it starts at the bottom, moves up, and then consolidates at the top, forming what is a large or heavy profile at the top. And what this profile is showing is 130,000 contracts traded. So now rollover's done. Volumes are back to normal, or should be, or expected to be. They shouldn't do anything. And what we have is a completely balanced overnight session on the gap. Now we are gapping into the prior trading ranges. As you can see here, we've been here before. Okay, so we're not trading in the in a void, but the overnight session is not offering up any real clues. Looking at the overall picture of what we have done, We need to get rid of this now. The S&P has done a good job of maintaining one-time framing up. One-time framing, one-time framing, one-time framing with higher lows. And then today it is actually looking like it's going to breach that. So it looks like we are starting a pullback phase into the gap zone. There's a gap zone below us that was formed on Thursday, and it looks like today we're likely to test that area down into 2918, I believe. And so that's how things are shaping up. We're taking a break. Look at Friday's profile, very boxy, a lot of trading throughout, and volume was normal on Friday, and it's just there's really no clear consensus on Friday's trade, and it's a selling day. We opened higher and closed into the prior day's range. And it looks like before we reach the mid-century figure at 2950, we're having a bit of a pullback. And pullbacks on a trend up are nothing more than the market advertising lower prices to attract what? To attract buyers. Looking at what we're expecting today. Primary scenario, I'm expecting this to be responsive, okay? So we have 2 days of balance. Those of you who have the master levels on IRT, you probably noticed the new point of control right there, 2936.75, and that's from the 2 days. So we have a micro composite that was built based on these 2 days. It's a fairly balanced composite. It's got this really sharp point of control. So coming into today, my expectation is for an open that tests below the low of Thursday into the gap zone and then becomes responsive. In either case, it may not test lower, who knows? But in either case, I'm looking, the primary scenario is responsive back into the point of control of Friday and then entangled into the 2936, 2937 area with the 38 stock zone behind it. This is what I'm looking for today as the primary play. All right. Pretty poor circle there. So responsive buying back into balance before the next move. Secondary scenario, we get the responsive buying on a grind, but then it's unable to get through that 3250, 33 stock zone. We get an impulse out and down, and we start to move into the gap. And remember, there's a gap zone down here, the gray area with a gap mid right at the prior all-time high at 2922.50. Okay, so the expectation is get into the stock zone, hold steady, bounce back up on the close. The two key scenarios right there. Responsive is the key scenario, and then the secondary scenario might get responsive but then reject, and I'm looking for the impulse. So it's important to watch for these impulses, right? So the impulse is when we finally activate. Why, by the way, somebody asked me, why do I care about these impulses and what is behind those impulses anyway? When the market moves lower and lower and lower, it's essentially saying, look, you didn't want to buy them at 29.35. How about 29.34? How about 29.33? How about 29.32, 31, 30, 29, 28, 27? And then the buyer's activated. Then we get to a price that seems advantageous to one or more participants of varying time frames. And then those participants act. They step in. And when they step in, it generally creates an impulse. It creates this aggressive move. Now, not always, but if it does, it tells us that it's the earliest sign possible, or the earliest sign that we have monitoring price action that tells us that buyers have been found when we have an impulse up. And once buyers have been found, we expect it to consolidate and then continue to push in the direction of buyers. It's already found its buyers, so the next rotation is likely to continue higher to seek sellers until we find the two bands of, okay, buyers are here, sellers are here, and then we go into balance and trade somewhere in the middle. And that's how the market mechanism on its most basic level operates, or is expected to operate, so that it does its job, which is to find balance. The market is there to find balance. It's to match as many buyers who demand a product with as many sellers who want to sell the product, right? eBay, your local supermarket, whatever. Same thing. It's not there to jack up prices. It's there to get as much merchandise moving as possible. And so is the function of this market. So that's what the impulse is built on. It's built on the idea that we have found the buyer or the seller, and now that seller or buyer are activated, and we're looking for them to continue to move in that direction. And so it's really important in these scenarios to understand that these little arrows that I draw here, right there and there, mean something. I'm looking for it. Okay, fine, you're grinding up and that's responsive. But if we get an impulse after that, I'm not looking to buy anymore. I'm looking to sell if we get an impulse down. And then I'm looking for my target, in that case, 29.2250, the prior high, the mid of the gap, and so on and so forth. So I'm able to more comfortably, not comfortably, trading is never comfortable. It's not natural to trade. I'm able to more comfortably hold on for my target as opposed to freaking out as soon as the market kind of pulls back to my entry, which is a big problem for most traders trying to execute. Anyway, that's my rant for this morning. Time is up. Good luck, everybody, and I'll catch you tomorrow. Take care.